a retired janitor from New Hampshire, left behind an $8 million estate. He never made more than $15 an hour. His method was simple, patient, and available to anyone. This video reveals exactly what he did. Let's start with the basics. When you own a share of a company, you own a piece of that business. And many profitable companies do something remarkable. They share a portion of their earnings with their shareholders every single quarter. These payments are called dividends. Now here's where most investors stop. They find a stock paying a fat dividend yield, collect their cash, and call it a day. But dividend growth investors think completely differently. They are not chasing yield. They are hunting for companies that raise their dividends year after year, like clockwork. Think about what that means. A company that raises its dividend by 10% every year will double its payout in just 7 years. You do not need to do anything. You do not need to trade. You simply own the right business, collect the growing checks, and let time work for you. The legendary investor Warren Buffett once described it this way. He wanted businesses with a growing stream of earnings that flowed to shareholders without requiring enormous capital reinvestment. Dividend growth stocks are exactly that. They are not exciting. They are not the talk of Reddit forums. But decade after decade, they quietly build wealth for the people patient enough to hold them. Here is the part that separates the merely good investors from the great ones. What you do with the dividends you receive changes everything. Most investors take those dividend checks, deposit them into a savings account, and move on. Dividend growth investors reinvest every single penny. This strategy is called a DRIP, a dividend reinvestment plan, and the mathematics behind it are staggering. Let us look at a simple example. Suppose you invest $10,000 in a company paying a 2% dividend that grows 8% per year. In year 1, you receive $200 in dividends. You reinvest that. Now you own slightly more shares. In year 2, those extra shares also pay dividends, and so do your original shares, which are now paying a higher dividend. This is the engine of compounding. Einstein reportedly called compound interest the eighth wonder of the world. He is supposed to have said, "He who understands it, earns it. He who does not, pays it." By year 20, that original $10,000 investment with dividends reinvested could be worth over $60,000 without you ever adding a single extra dollar. The dividends did all the heavy lifting. This is why starting early matters so profoundly. Every year you wait is a year of compounding you can never get back. So how do you actually find these exceptional companies? There are 4 criteria every serious dividend growth investor uses. First, dividend history. Look for companies that have increased their dividend for at least 10 consecutive years. The S&P 500 has a special group of companies called dividend aristocrats. These are businesses that have raised their dividend for 25 or more consecutive years, including through recessions, market crashes, and global crises. Second, the payout ratio. This tells you what percentage of earnings a company pays out as dividends. A payout ratio under 60% is generally sustainable. If a company is paying out 90% of earnings as dividends, there is little room for growth, and the dividend is fragile. Third, earnings growth. A dividend can only grow if the underlying business is growing. Look for companies with consistent earnings growth over 5 to 10 years, not explosive growth, consistent, reliable growth. Fourth, balance sheet strength. Companies with low debt and strong cash flow can sustain dividends even during economic downturns. They keep paying when weaker companies cut. When a company passes all 4 of these tests, you have found something rare, a business built to reward its shareholders not just today, but for decades to come. Let us look at some real examples so you can see this strategy working in the real world. Coca-Cola first paid a dividend in 1893. It has not missed a payment since. Today, Coca-Cola has raised its dividend for over 60 consecutive years. If you had invested $10,000 in Coca-Cola stock in 1990, reinvesting your dividends, that investment would be worth over $200,000 today. Procter & Gamble tells a similar story. The maker of household brands like Tide, Pampers, and Gillette has increased its dividend for over 67 consecutive years. 67 years. through oil crises, dot-com crashes, the 2008 financial meltdown, and a global pandemic. Johnson & Johnson, another dividend aristocrat, has raised its dividend for 61 straight years. Now look at what these companies have in common. They are not glamorous. They make soda, shampoo, Band-Aids, but their products are used by billions of people every single day, regardless of what the stock market is doing. That predictability, that inescapable demand, is what allows them to keep raising dividends. Warren Buffett calls them businesses with a moat, and he has spent his career buying them. The lesson is simple. Boring businesses, in the right hands, become extraordinary wealth machines. Here is the practical question. How do you actually start? First, open a brokerage account if you do not already have one. Platforms like Fidelity, Schwab, or TD Ameritrade offer commission-free trading and automatic dividend reinvestment plans. Second, start with what you have. You do not need $50,000 to begin. Many dividend aristocrats cost less than $100 per share. Buy one share a month if that is all you can afford. Third, diversify across sectors. The classic dividend growth portfolio includes companies from consumer staples, healthcare, utilities, and industrials. Not just one sector, multiple. This protects you if any single industry hits a rough patch. Fourth, think in decades, not quarters. The investors who build real wealth from dividend growth investing are not the ones checking their portfolio every morning. They are the ones who set up automatic reinvestment, choose quality companies, and let the machine run. Fifth, track your dividend income, not your stock price. The market will go up and down. Your dividends, if you chose wisely, should grow every single year. Focus on that growth number. If your dividend income is growing, you are winning, regardless of what the stock market says on any given day. That janitor from New Hampshire? His name was Ronald Reed. He held his positions for decades and never wavered. He trusted the machine. Dividend growth investing is not a secret. The information is public. The stocks are accessible. The only ingredient it requires is the one most rare in investing: patience. If this video helped you understand why the quiet, boring strategy has produced more millionaires than any other, then hit subscribe. Every week, Market Mapped brings you deep dives exactly like this one. Your financial future starts with one decision.